Now it's time to get into the meat and potatoes of my potential disagreement with the money guys. Should you have more than a year's worth, up to 2 years worth, of your expenses saved in an emergency fund, effectively in cash, when you're retired? Should you use the two bucket strategy when it comes to retirement? If you're not familiar with the bucket strategy, then a lot of the story might not make sense right now, but it's effectively this. Imagine you have your investments, be them in stocks, equities, or bonds, or some sort of combination of the two. You keep them balanced. You exercise traditional rebalancing between them. And that is your nest egg. It's grown to the point that you feel like you can retire, but it's volatile. You are not comfortable with how much the market goes up and down, how much your nest egg's value can fluctuate even month to month. And why are you uncomfortable with this? Why are you uncomfortable with the volatility? Well, when the market's up, that's not a problem. But if it's down and you want to take some income out of this nest egg because you need an income coming out of your nest egg every month, if it's down, it's not a good time to take money out of the market. It is an inefficient time. In short, volatility is scary, and it would be nice to not have to rely on your nest egg when the market is down. And that's the whole philosophy behind the two bucket strategy. You keep that 1 to 2 years of expenses in cash so that you can live off of it for the duration of a recession when the market is down. That's kind of the idea. Simple. On the front of it, you've got your nest egg over here invested, and you got your cash over here. And depending on how your nest egg is doing, you live off of one or the other. That's it. Well, I wish I could say that's it, because there's a problem. If you have your cash bucket depleted, in part or in whole, how do you go about filling it back up? And how do you know when is a good time to fill it up? Do you just start filling it up as soon as it's empty? Do you fill it up once the market's recovered? And what's the definition of the market having recovered? Does it need to exceed when you started pulling out cash? Does it have to hit a new high? Where are the boundaries here? What are the assumptions? And then when you are ready to start filling it back up, do you do it all at once? Do you do it progressively over time? If you fill up your cash bucket too fast, you may unduly deplete your invested nest egg. And if you fill it up too slowly, you might not have enough cash by the time the next dip hits, and you need to go back to withdrawing from your cash bucket. Now, if that wasn't clear enough and you have access to the video version of the podcast, I created a flow chart example for us to walk through to help us make sense of the situation and make sense of how I modeled my two bucket strategy simulation. What we're going to do now is walk through this visual aid to help understand the assumptions that I made in modeling the two bucket strategy. What we have up top first in the orange bucket is your investments. That's going to be bucket number 1. The blue represents your cash bucket. This is going to be your 2 years worth of emergency fund. I did try modeling 1 year, 18 months, and 2 years. And what I found is that the 2 years was nearly optimal for the 30% bonds, 70% stock portfolio. And then below that, we have the green, which represents the income that is coming out of either the orange bucket or the blue bucket, bucket 1 or bucket 2. And we're pulling that every month. Next, we're going to talk about this line graph. It's the example to illustrate the floor and fill lines. When I covered the financial guardrail method, I talked about a floor, where you take the amount of money that's invested in your nest egg and you correct it for inflation. That way you have a line that represents the initial buying power. And anytime your nest egg dropped below that line, anytime your nest egg that was invested fell below its initial buying power, you would default to a more conservative safe withdrawal rate until the market recovered. Well, in this case, we're going to maintain that trigger. Any monies that are invested get corrected for inflation, and anytime the invested amount in bucket 1 falls below its initial buying power, you're going to default to using the cash bucket. You're going to start withdrawing from bucket number 2 until the market recovers. But if the market were to recover just barely above the red line, and you started taking money out of bucket number 1 to fill up bucket number 2, you're going to put an increased pressure on your invested nest egg, an increased pressure on bucket number 1. This will result, probably in many cases, dropping below the floor again. So you end up with this oscillation this little confliction of how much can I pull without pushing myself down to the floor and needing to keep pulling out cash. And it is for this reason that I don't use the red floor line as the trigger for filling up bucket number 2 again from the surplus in bucket number 1. That's what this yellow line is. The yellow line is, in this model, representative of the floor line shifted up by 1 year's worth of expenses. So if you had a 4% safe withdrawal rate that you were applying with the strategy, this would be 1.04 times the floor across the board. So once you get 1 year's worth of expenses above the floor line inside bucket number 1, you can then start filling up bucket number 2 from the surplus. And in this model, I have assumed that you fill up the cash bucket, bucket number 2, at a rate of 2 times your monthly income, 2 times your monthly safe withdrawal rate. So in a month when you are filling the cash bucket, you're pulling out 1x of your monthly expenses for you to live on, and you're pulling an additional 2x of that same number to put into bucket number 2. Effectively, if your cash bucket is depleted by any amount, once you get above the fill line, you take out 3 times the pressure from bucket number 1 until bucket number 2 is filled. And because that's kind of confusing, I've developed a flowchart to walk us through the decision-making process that becomes relatively complicated for a concept that looked so simple on the surface. Okay, the flowchart starts here at the gray circle, the month starts, and the first question that's asked is, does bucket number 1 exist above the fill line? If so, the next decision is easy. Just take your monthly income out of bucket number 1. Don't worry about bucket number 2. After that, you need to ask yourself if bucket number 2 is full. If it is, then you can move on to the end of the month. That's all the decisions you have to make for now. But if your cash bucket is depleted, if the answer to this decision is no, then we come over this way and engage with the assumption that we need to fill the cash bucket up by withdrawing from bucket number 1 up to 2x our monthly income to put into bucket number 2. Now, this is as good a time as any to say that for the cash bucket, I assumed that it was invested in a high-yield savings account and maintained through surplus in the budget so that it never fell below its initial buying power once it was full. So naturally, you're going to engage with this step up to the point that your second bucket, your cash bucket, hits its initial buying power from when you started retirement. If you go down this path, you're done. You can go over and end the month. Now let's go back and say your nest egg isn't above the fill line. You simply say no. Well, now we have to ask ourselves, is our nest egg below the floor? Because if it's below the floor, the next action is clearly going to be going to bucket number 2 and trying to get our income from it. However, there are cases where you may be more than 2 years in a recession. You may have completely depleted everything that was in the cash bucket. So it's important on the flowchart to ask if bucket number 2 had enough money for your income. If so, that's it. You go and end the month. But if not, you have to engage with the behavior that the bucket strategy is trying to have you avoid, and that is taking money out of bucket number 1 when the market is down. You do this up to the amount of money that you need for that month and then end. But what if you were here and you said, no, my nest egg isn't below the floor? So you said, no, it's not above the fill line. No, it's not below the floor. Well, now you live between the yellow and the red lines. You live in limbo. And this is where the model kind of gets extra confusing, because do I take out cash now or do I take out from the investments? Well, this is going to be dependent upon how last month's income was withdrawn. Because if we came from above the fill line, dropped below it, but hadn't yet hit the floor, we should still be taking out a bucket number 1. Meanwhile, if we were taking out a bucket number 2 because we fell below the floor and we were coming back up, but we hadn't yet hit the fill line, we should continue taking out of the cash bucket. That's why this decision-making factor right here was last month taken out in cash? If the answer is yes, you continue taking out cash because you're still waiting for the market to recover. If the answer is no, you continue taking out of bucket number 1 because you have not yet fallen below the floor to trigger needing to engage bucket number 2. I hope that flowchart and the visual was helpful for understanding how I made this model. It was a little difficult putting it into a spreadsheet, so this particular one took much longer to run than my initial study. And before we get into the statistical results, I want to tell you I did use my inflation corrected data. I didn't assume a flat 3% for inflation. I had an episode just recently where I redid my study and said, let's make everything relative to actual inflation. And that was extended to this work. So, how well did the bucket strategy actually help us in different scenarios with different portfolios in bucket number 1 and different time horizons? To answer that question, let's look at the 20-year time horizon data, which looks more similar between the flat withdrawal rate data that's on top and the bucket strategy data that's on the bottom. Really, across the board, for the 20-year period, there is almost no tangible difference anywhere with any practical portfolio that I can point at. There are minor changes within like 0.2, 0.4%, but none of them changed the boundary for the 95% confidence line or the 90% confidence line within the confines of my study. When it comes to the average expected ending nest egg value, the amount of money that you could leave as an inheritance, across the board for the practical results, I see that the bucket strategy reduces how much you leave to your heirs by 100,000 to maybe 400,000 across the board for the practical portfolios in the 20-year time horizon. And it continues to blow my mind just how close the data is here for the 30-year time horizon. For the lower safe withdrawal rates, it doesn't matter if you use the flat safe withdrawal rate or the bucket strategy, like at all, regardless of the portfolio mix. The results are effectively the same. When you get up to the higher safe withdrawal rate, say 4 to 5%, the bucket strategy may give you a benefit, a slight benefit, depending on the portfolio mix you're using. For example, the 30 bond, 70% stock mix has an additional cell. The 4% safe withdrawal rate is now added to the 95% confidence line. But before, it was 94.8% confidence. It was pretty stinking close already to being within that boundary. The change is so small. And again, with the average ending nest egg value across the board for the practical portfolios that don't end up leaving you with a diminished buying power, I see that the bucket strategy reduces what you can leave to your heirs in the 30-year time horizons from 200,000 to closer to 1.5, maybe even $2 million. That's incredible. It continues to blow my mind that a strategy that is designed to be more efficient ultimately ends up costing you money in the end. Because in an effort to be efficient for monies that are invested, it is sidelining too much money to actually get you ahead if your main goal is to maximize how much you leave to your heirs. For kicks and giggles now, I'm looking at the 60-year survival rate data. This is the longest time horizon that I ran. And again, the odds of survival between just taking out a flat safe withdrawal rate and implementing the bucket strategy with any base safe withdrawal rate is negligible. In fact, the boundaries again for the 95% confidence in the 90% confidence are the exact same between the results. Okay, so effectively what we have here, if your goal is to minimize risk, and you want to minimize risk by implementing the bucket strategy, you're simply engaging with a placebo effect. It is a more complicated strategy from a decision-making process that gets you from the model I had, absolutely, positively, no gain over a flat safe withdrawal rate approach for mitigating sequence of returns risk. And because there really is no difference, I can't say that it's a bad strategy for mitigating risk. It just has an equal in something that is simpler. I believe that this strategy falls short of making goals a reality compared to a flat safe withdrawal rate. Within the confines of my study, within my assumptions, there is no benefit to it unless it helps you sleep better at night. And there is something to be said about that, but it's also a more complicated system to run. If you can become more comfortable with a strategy that's more viable, that does a better job, then hopefully you can sleep at night better implementing that, knowing that it is safer than keeping 2 years in cash on hand throughout retirement. Now, for the sake of completeness, I want to explain one more assumption that I made. When it came to the way that I modeled the nest egg, I said that the initial $1 million that you retire with includes the cash. So imagine you invested until you hit $1 million, and when you're ready to implement the bucket strategy, you take the cash out right away on day 0 or day 1 of your retirement. Make that your bucket number 2 and leave the rest as bucket number 1. And your safe withdrawal rate is still based on the initial nest egg value that you had between the 2 buckets. I didn't want to assume a diminished income in order to apply the bucket strategy. To do so may skew the results by basically shifting all of the withdrawal rates to something that's lower if I made it relative to what I left only in the nest egg. And in other words, if I were to say $1 million is invested in the cash bucket is on top of that, well, I'm basically just throwing money onto the pile and skewing the results in the favor of the bucket strategy by feeding it more money in the simulation. You see, I made these assumptions because I wanted to successfully illustrate the trade-offs of if you retired with $1 million and you could apply it to, say, a 4% rule strategy or a bucket strategy. You're not going to go and find newfound cash. There are trade-offs between that exact same amount that you have for retirement. And that's really what I've tried to illustrate here. And now I want to know what you think. Was today's episode helpful? Do you think that there are other assumptions or other tweaks to the parameters to the 2-bucket strategy that could make it more helpful and viable in some situations? Really, do you side with the money guys and their logic on this? Or do you side with the results from my study and experts like Rob Berger, who also stands against the bucket strategy as being a, mathematically speaking, good withdrawal rate strategy? I look forward to reading your comments. And until next week, until next Tuesday, budget bravely and enjoy your hope-filled financial future.